Welcome. In this video, will ZBCN coin rise more? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
When carefully examining the chart, it becomes evident that price movements have been under downward pressure over time, forming a structure characterized by consecutively lower highs. This pattern is defined in technical analysis as a descending trend line and indicates that the market has been under the control of sellers for a certain period. Each new peak forms below the previous one, showing that buyers have yet to break the pressure and that sellers continue to resist. However, the current price movement approaching this descending trend line now signals a technically critical junction. Descending trend lines formed by connecting the peak points of price act as diagonal resistance levels and hold not only visual but also psychological significance. Every approach to this line raises the question in investors' minds: will it break this time? This expectation gradually transforms into a rising potential over time. If the price manages to break this line to the upside, it not only means a resistance level has been breached, but also symbolizes a fundamental shift in market dynamics, indicating that buyers have finally taken control. The current process revolves exactly around the possibility of such a breakout. For some time now, the price has been approaching this descending trend line, and during this approach, changes have been observed in indicators, trading volume, and investor behavior. Especially the increase in volume as the price nears the trend line shows that buyers are now beginning to take positions more decisively at this level. This is an example of what technical analysts refer to as pre-breakout positioning. Trendline breakouts often serve as signal points not only for technical analysts, but also for algorithmic trading systems and large portfolio managers. An upward breakout of a descending trend line is considered a reversal signal, and such signals are used as triggers in many automated strategies. Therefore, if this trend line breaks, it may prompt not just retail investors, but also large funds to take positions, laying the groundwork for a stronger and faster rally following the breakout. Psychologically, descending trendline breakouts are also important events that boost investor confidence. A price that has been suppressed for a long time, finally breaking through this pressure, creates a positive perception in the market. The fear of missing out, FOMO, often kicks in after such breakouts, prompting investors to quickly enter long positions. This sudden shift can lead to a sharp rise in volume, accelerated price movement, and a faster achievement of technical targets. When reviewing past price behavior, it's common to see sharp upward moves following similar descending trendline breakouts. This is because such breakouts are considered trend reversal signals in technical analysis. An upward break of the descending trend line indicates that sellers have lost their influence and a new bullish trend has begun. This trend can sometimes evolve from a short-term bounce into a new upward trend lasting weeks or even months. At this point, investors should pay attention to several important technical details. First is determining whether the breakout is a real one. In technical analysis, it's not enough for the price to merely rise above a trend line. There must also be support from trading volume behind the move. If the price breaks above the descending trend line with increasing volume, the breakout is more likely to be sustainable. Otherwise, the breakout may be a fake breakout, and the price could fall back within the descending trend. The second important factor is the potential retest that may occur after the breakout. Typically, after breaking a descending trend line, the price may return to test this line in the short term. This test is important to determine whether the broken resistance will now act as support. If during this test, the price reacts upward without falling below the line, this is interpreted as a confirmation of trend reversal. From this point forward, the upward movement tends to continue more strongly. Potential targets that may emerge with the breakout of this descending trendline can also be calculated using technical analysis. By considering previous price ranges formed before the breakout, Fibonacci retracement levels, and past support and resistance zones, it is possible to estimate how far the price may rise. Especially the formation of a new upward trend structure following the breakout can offer new buying opportunities for investors. In conclusion, the descending trend line currently being observed on the chart represents an extremely critical level from a technical analysis point of view. The price is approaching this line, and buyers are beginning to gain strength. If this trend line is broken to the upside, a bullish trend reversal will occur in the market, providing major opportunities for investors. Indicators, trading volume, and market behavior are signaling that such a breakout may be near. Therefore, this development should be monitored closely, and position planning should be carried out with proper risk management. But we can't base decisions solely on trend lines. Let's now take a look at other metrics as well. Stay tuned.
When the current structure on the chart is carefully examined, it becomes apparent that the price movements are forming a highly orderly Elliott wave pattern. This structure involves specific price actions corresponding to the psychological stages of the market and is typically defined by a 5-wave sequence in either an upward or downward trend. At present, there are strong technical indications that waves 1 and 2 have been completed and that the price is now at the beginning of wave 3. This represents a highly significant phase for investors, as wave 3 is considered the strongest and fastest moving segment of the entire 5-wave structure according to Elliott wave theory. Therefore, it is the most notable wave in terms of both price targets and momentum. In the nature of Elliott wave patterns, each wave represents a specific psychological stage. The first wave often appears as a small spark of hope in the market. Most investors do not take this move seriously and still believe the previous downtrend will continue. However, the second wave retraces some of the first wave's gains and tests the market. During this phase, many investors hesitate to buy, expecting a double bottom. It is precisely at this point that wave 3 begins. This wave marks the stage when a broad segment of market participants begins to recognize the uptrend, news flow turns positive, and buying activity accelerates. The technical characteristic of wave 3 is that it is usually longer and accompanied by higher volume than wave 1. According to Elliott rules, wave 3 can never be the shortest wave. This rule, especially when combined with Fibonacci projections, provides extremely strong targets. In the current price structure, wave 2 appears to have ended and wave 3 may have begun. At this point, technical analysts measure the length of wave 1 and use Fibonacci extension levels to project potential targets for wave 3. The most commonly followed levels are 1.618, 2.272, and sometimes 2.618. The 1.618 Fibonacci extension is considered the minimum target for wave 3. A wave 3 reaching this level meets theoretical expectations. However, if the market has strong momentum, as is often the case during wave 3, prices frequently extend to 2 or even 2.272 levels. In some extreme market conditions, the 2.618 level can also be exceeded. These points act not only as technical targets, but also as psychological zones where profit-taking begins and subsequent waves start to take shape. The current price movement may be signaling the very beginning of this third wave. The sharp rise following the completion of the second wave indicates a strong increase in buying demand. Momentum indicators also appear to support this rise. For instance, the RSI may have broken above previous peak levels and established a new upward trend. The MACD may have crossed to the upside in the positive zone with growing histogram bars. These indicators provide strong supporting signals that wave 3 may have begun. Moreover, wave 3 is not only technically significant, but also emotionally the most interesting phase of the market. During this time, investor sentiment turns excessively optimistic. Positive news flow increases in the media, bullish narratives spread on social media, and new investors begin entering the market. This drives prices even higher. Therefore, wave 3 reflects not only a technical phase, but also a collective rally euphoria. This rally euphoria is often supported by rising volume. As new investors enter the market and see prices rising, they assume the trend will continue and start opening positions. This causes wave 3 to rise much faster and more sharply compared to wave 1. In technical analysis, this phase is referred to as the momentum peak. If the price surpasses the 1.618 level during this rise, the next likely targets become 2 and then 2.272. These Fibonacci levels are the strongest technical target zones to monitor. Additionally, the internal structure of wave 3 can be analyzed. According to Elliott wave theory, every impulse wave contains 5 subwaves. In this context, wave 3 is assumed to consist of 5 smaller waves on a micro level. This substructure offers more detailed signals for shorter-term analysis and helps confirm the strength of the trend. For example, once the first internal subwave of wave 3 completes, a brief correction forms the second internal subwave. If the third internal wave begins after this correction, it represents a miniature third wave within wave 3, suggesting that the price may rise rapidly in the short term. In conclusion, considering the current technical outlook and price behavior, it appears that the price may now be taking the first steps of the third main wave according to Elliott wave theory. By its nature, this wave is expected to reach at least the 1.618 level. However, depending on market enthusiasm and momentum, the probability of extending to 2 or even 2.272 levels is quite high. Therefore, investors should monitor this phase carefully, structure their positions accordingly, and not neglect risk management along with technical targets. Because while third waves always present major opportunities, they are also the phase where emotional, uncontrolled trades are most commonly seen. For this reason, a disciplined approach, technical confirmations, and clear strategies will be the investor's most powerful tools during this rally phase.
RSI, one of the most frequently used indicators in graphical analysis that gives traders an idea of both direction and momentum, is not only limited to detecting overbought or oversold zones. It also reflects the mood and directional tendency of the market with trend structures that form over time. At the moment, the RSI indicator has a clearly observable rising trend structure, which is critically important for market participants. This rising trend reveals not only momentum, but also the emotional disposition of market participants. Maintaining such a trend is essential for price movements to continue their upward momentum. Such trend structures on the RSI indicator work as strongly as the classic rising trend lines observed on the price chart. In some cases, they even give even more prominent signals. This is because the RSI tends to change before price movements. If an asset's RSI is moving along a rising line, this indicates that there is an ongoing demand on the buy side and sellers are failing to meet it. Therefore, the RSI maintaining this trend structure is technically a very positive sign for the sustainability of a bullish scenario. A rising RSI trend builds a level of confidence among traders over time. This trend line works as a momentum support line for the RSI. Failure to break below this line confirms that traders are still determined, that they are still holding their positions, and that the overall direction of the market is up. Even if the price experiences minor corrections during this period, the fact that the RSI maintains its trend line indicates that these corrections are healthy and temporary and may create new buying opportunities. Currently, the chart shows that the price is approaching this rising line on the RSI again. This contact is extremely important because such points are often interpreted as a moment of decision in the market. If the RSI bounces off this line and turns back up, it's a sign that buying pressure is still strong and the price will continue to rise. In this case, traders can reposition, maintain, or strengthen their current positions.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon!